Hello, everyone. Thanks for joining our webinar today. Go here. My name is Erin Campbell, and I am the Regulatory Research Services Manager at the NAIC Center for Insurance Policy and Research. On behalf of CIPR and the Institute's Griffith Foundation, we welcome you to this installment of our Back to Basics webinar series. The goal of this series is to take a look at the fundamentals of an issue in the insurance space to better inform our public policy conversations. Previous webinars in our series have covered topics like captives, fraud, reinsurance, surplus lines, and guarantee funds. This session today will cover the history and development of private and public flood insurance. We'll talk about the current state of the market and about the role of the federal government. We'll also hear insights into the challenges and lessons learned from recent catastrophic flooding events. Our expert speakers for today are Dr. Lori Metters, Dr. Dan Kanuski, and Rosemary Razka. Information about our speakers is available via a program. I will put a link to the chat or a link to the program in the chat in just a moment so you can find out more about our speakers. Our Q&A segment today will be moderated by Frank Tomasello of the Institute's Griffith Foundation. The program also contains information about DRC credit, and there's also a link to the recordings of our previous Back to Basics webinars. We are recording the webinar today, and that will be available at the same link in the next couple of days, as well as on our CIPR and Griffith websites. We'll be using the Q&A function for questions, and we'll try to get to as many of those as possible at the end of the program today. So please feel free to drop your questions there throughout the next hour. At the end of the session, you'll be prompted to fill out a very brief survey, and we do appreciate your feedback on this webinar as we plan for future events. And now I'm going to hand things over to Dr. Lori Metters to kick things off.
Thank you, Erin, and thank you to the Griffith Foundation. Happy to be here today. My part in the conversation with you today is really to focus on the history of the program and to kind of bring us up to speed on where we are today with the program. So, Erin, do I just let you know when I'm ready to advance the slide? Is that okay? Got it. Yeah, so the flood insurance program, the National Flood Insurance Program, was established in 1968. That was not an easy establishment. We'll talk about that in a minute, but it was created in 1968 to address the problem of a lack of private flood insurance. So you'll see by the end of the webinar that, that in some respects, the market has gone, if not full circle, has come around again where private insurance is interested in this market. And the problems and the key issues that we see with the NFIP today that I will bring us back to before we move on to the next speaker are that you may well know already that the program is in a tremendous amount of debt and with increased borrowing limits over several times, over several years, and that in one case, debt had to be canceled to a large number for there to be sort of a reasonable hope that the NFIP might be able to repay within reasonable periods of time. The program is also suffering from short-term reauthorization restrictions. So the restrictions are that because the reauthorizations have to be done periodically, it creates restrictions in mortgage markets and in other markets that depend on knowing that the flood insurance is in place. And there are affordability issues we'll talk about, as well as issues around mapping accuracy. I won't spend as much time on mapping accuracy. That moves us a little bit into the future, but just to give you the sense that that is still an issue, a challenge within the program. Next slide, please. Okay, so to walk you a little through the timeline of, as I said, the program conversation didn't start in 1968. NFIP was established in 1968, but insurers knew there was a problem, banks knew there was a problem, and homeowners knew there was a problem earlier than 1956. And so they knew it well enough that bills had been put in place in Congress to try to pass a federal flood insurance act. By 1956, they tried to pass one, but it did not pass. So it took 12 more years to pass one, just to give you a sense of how over the history of the program, there's been controversy around how it would work, whether it could work well. So that is not a new issue. That was an issue from the start. And then in 68, as we've said, we did officially establish the NFIP. By 1973, the Flood Insurance Protection Act mandated that certain homeowners in high-risk areas would have to purchase flood insurance. By 1979, the NFIP was placed under FEMA. And in the 1990s, we really began to see some of the bigger losses that not the remnants of which still haunt us today, but we began to see big losses that placed real pressure on the system. Next slide, please. Such that by 2004, the Flood Insurance Reform Act was passed to address patterns that the NFIP and FEMA were seeing in how losses were occurring. So there were, of course, repeat losses in areas, repeat homes and properties that were being that were experiencing damage, and they had had 35 years by then of the program to be able to see patterns and repeat losses. So the Flood Insurance Reform Act was passed primarily to address those issues of repetitive flooding, and repetitive flooding, particularly in certain communities and with certain properties. By 2005, we experienced Hurricane Katrina. I don't probably have to tell anyone in the room how much pressure that placed on the NFIP. That was a huge flood event and wound up being a bigger flood event than even thought initially. And then the NFIP needed to increase its borrowing from the Treasury. By 2012, not none of that, but that had not been repaid. That borrowing had not been repaid. The NFIP was under pressure. It was reauthorized for 5 more years by Biggert-Waters. And then following that, we suffered from the Hurricane Sandy losses. So the NFIP in that same year was hit with another really big loss. That by 2013 increased the debt again that the NFIP owed the Treasury, and the Congress increased the borrowing limit of the NFIP to adjust to that. In 2014, the Homeowner Flood Insurance Affordability Act was passed, and that rolled back some of the changes that were made by Biggert-Waters, or at least froze them so that it delayed premium increases that would have otherwise occurred, and reinstated some high-risk properties flood insurance policies under a grandfathering. Next slide, please. By 2017, we had another big year because there was Hurricane Harvey, Irma, and Maria, if you recall, in addition to some other storms and other flooding that took place across the country. And Congress in that year wound up canceling a large portion of the NFIP debt. By 2022, the NFIP was reauthorized with short-term extensions, and the current authorization is set to expire at the end of September this year, so we would need another reauthorization for the NFIP for it to continue to operate. In 2023, the NFIP fully implemented something called Risk Rating 2.0, which is a new pricing approach that's aimed at getting a better risk to price matching so that prices would be more actuarially fair and premiums would better match the actual risk to the individual property. 2024, just about a month or two from now, will be on the first anniversary of Hurricane Helene, which hit the area where I live. And so firsthand, I can say how devastating this was. It resulted in a surge of claims and a lot of uncertainty around how big these claims would be for the NFIP. By the end of 2004, FEMA was estimating $4.5 billion in losses due to Helene. And in fact, by early 2025, they had raised that number, that estimate, to 7.4 billion. So within a 2 or 3 month period, FEMA raised that estimate by quite a lot. And so FEMA then needed to borrow $2 billion to pay claims from that hurricane season. And that wasn't just due to Helene, but also due to Milton. Next slide, please. Okay, so really quickly, just this slide, to be honest, is mostly for your benefit so that you just have a little more detail around the financial picture. The story on this slide really is simple. It is that pre-2005, if you want to think of it as pre-Hurricane Katrina and some of the other several hurricanes that made landfall in the US that year, pre-2005, the NFIP and FEMA had always been able to repay any loans that were taken out from the Treasury without much fanfare. They had never had to take out what we would have called at the time a huge loan. And so the program had rocked along with most states in a surplus. And the program was working fairly well. Of course, the 2005 hurricane season changed all of that. Since the 2005 hurricane season, the NFIP has never not been in debt again. So it has been in debt and its debt increases. It has been beset with challenges, obviously, since 2005, a lot of that being due to very large hurricane events, but not all of it being due to hurricane events. As we're seeing with the recent Texas flooding, there are other flood events that occur that can be quite devastating to communities and also to the NFIP that are not hurricane related. And then recent developments in 2025, so since the beginning of the year, we are dealing with a big former hurricane season, in debt from seasons before that as well, and looking at the largest, if it had not been for the cancellation of debt in 2017, we would by far be looking at the largest debt that the NFIP has ever been in. And in addition to that debt, they have the ongoing concerns of inadequate premiums to actually cover the frequency and severity, particularly of the hurricane potential. We have the uncertainty around reauthorizations and other issues that we will talk about next. Next slide, please. And so you can see a picture of the debt history. I did not make this graph, so it does not include where we are exactly right now. But I think the graph beautifully depicts the problem. It gets us through 2024, where it tells the story of how much debt the NFIP is experiencing. And if you compare that to the losses, and you see the losses in that upper blue line just still escalating, and how we have had to step up borrowing capacity, borrowing limits, and mostly use the borrowing limits that have been available each time in order to create debt to pay claims. Next slide, please. So a little conversation I mentioned to you in a previous slide, risk rating 2.0. This is an attempt by FEMA, which they put much effort and time and resources into over a period of years to try to address the problem of there being quite a bit of subsidy that took place within the NFIP, where a higher risk property that had a flood insurance premium that might otherwise be unaffordable for a resident or for a business, that premium would be subsidized by either general taxpayers, or it was being subsidized by other people in the program who had maybe a lower risk, but still high enough risk to be attracted to buy flood insurance. And over time, those subsidies became more and more observable. Early, if you recall, when we were able to borrow just small amounts and repay those, the public and banks are not as concerned about subsidies that might be taking place because the program's taking care of itself, and everyone, for the most part, is finding the product affordable. But when we reached a point where we had to increase borrowing limits and the premiums are going up, and people could sense that their premiums might be higher than they thought they should proportionately be paying to their risk, then transparency became of paramount importance. And so part of what risk rating has done is to create transparency around the pricing and to try to the extent practicable, to put pricing on these policies that is matched well to the actual risk of an individual property. So this is unlike a lot of insurance policies where you're trying to match within territory and like construction. This is actually trying to utilize world-class, the best-in-class modeling to actually price according to the exact risk for that property. Next slide, please. And so what then happened, once any subsidies that were left in the program before Risk Rating 2.0 were sort of phased out with the advent of Risk Rating 2.0, you can see that for the vast majority of people, their premiums didn't change that much. There were a significant number of people for whom the premiums did come down, premiums declined, because they may have been subsidizing other homeowners before. And then at the upper end of risk, you can see a small percentage of folks for whom the premium may have increased quite dramatically. Next slide, please. Okay. Since, and you can say that this is coincidental, you could say it is due to Risk Rating 2.0. You could say that this is due to the advent of private flood insurance that's now available. And I think it's probably due in part to all of these factors. But the actual percentage and value of flood insurance policies in effect is falling in the United States, which is, this is not what we want to see it do. But we are seeing a decline in people purchasing the insurance, and that's a declining percentage of homeowners as well as a declining total number. Next slide, please. And other speakers will speak to this in more detail, but just to kind of set up a bit for them, this declining participation could be due to lots of reasons. The ones that we can think about very easily and see very quickly are the affordability challenges that we've discussed. Once you place equitable premiums or equitable prices onto something that's risky, you're going to see instances where people just cannot afford it. And especially in a high risk area where someone is low income. Growth of the private insurance market, certainly to some extent, is resulting in declining participation in the NFIP. To the extent that people can purchase a better product at a cheaper price in the private market, they may do so. People do continue to have misconceptions. A first misconception is they think their homeowner's insurance might cover flooding. It's hard to believe people might still have that misconception, but they do. And I learned that firsthand in the aftermath of Hurricane Helene. I also know firsthand and from research, both, that many people think that if they cannot show that they're in a high risk area, that they actually are not going to be eligible for flood insurance. So there's a huge misconception out there in the public that many people aren't eligible, who in fact the flood insurance program would probably like to cover, to have some more lower risks in that marketplace. Then there are purchase requirement issues. Most homeowners are not required to have the coverage, and the homeowners that are required, there are many instances where they're not getting as much insurance as they need. If they have a home that could be damaged to the tune of more than $250,000, for instance, the National Flood Insurance Program coverage is not going to adequately insure them for that. And then the insurance inadequacy, sorry, I just mentioned that, but the insurance inadequacy goes further. If we are seeing declining participation rates, then what we're seeing is a growing risk where we have a lower percentage of people taking the coverage. So we're seeing not just an increasing problem of underinsurance or inadequate insurance, but we are seeing potentially an exponentially growing problem. And last, just reminding you of the program instability. This is a program that has become reauthorized on a periodic basis without the reauthorizations. Banks get nervous, real estate transactions can be affected, And of course, homeowners can be affected in terms of actually having their homes protected from flood. I think that is my last slide. And thank you for your time. I'm happy to take questions at the end.
Professor Metters, thank you very much for helping us to better understand the history and the development of flood insurance here in the U.S. In just a moment, we'll welcome Dr. Dan Kanuski to our microphones, but first a reminder to our remote audience. We will devote the final 10 minutes or so of our program to Q&A. Attendees, you may submit questions using the Q&A feature in the webinar interface, and we will review incoming questions and address as many as time permits. With that, it's a pleasure to welcome Dr. Dan Kanuski to speak to the current state of the flood insurance market. Dan, thanks for being with us. The floor is yours.
Thank you, Frank, and thanks for having me. It's really a pleasure, and I thought that was a great overview that Lori just provided. And I'm going to build on that. I'm going to talk a little bit about my experience when I was at FEMA. So I was at FEMA in 2017 to 2020, which was quite the time to be at FEMA. It was on the heels of Hurricanes Harvey, Irma, and Maria, and the devastation that was left in the wake of those disasters. That devastation, of course, included flood, that significant flood impacts with all three of those disasters, and significant impacts on the NFIP and its ability to both support current disaster survivors, as well as to ensure for the financial stability of that program going forward. As Lori mentioned, there was significant debt that is accrued over the course of the program's history, but largely that debt has been the result of a handful of major flood events. One of those, of course, is Hurricane Katrina. I was again in government during Hurricane Katrina. I promise I'm not the cause. I just happened to be in government during all these catastrophic disasters. And when I joined the White House just 3 weeks after Katrina, little did I know how that would shape my career, as well as shape the National Flood Insurance Program. In fact, it was driven at that point deep into debt. And as Lori mentioned, there were actions that were taken in the subsequent years to address that debt, including the canceling of debt at certain points along the way. But the reality is the program remains badly in debt. And until that debt is handled one way or another, there's debates about, well, shouldn't the debt just be canceled? Because on the one hand, you have FEMA paying interest on that debt to the U.S. Treasury, and so on the other hand, it's the government, right? So the federal government's paying the federal government interest on that, $20+ billion of debt. And as someone who cares about, and I think all of us do, about good government, from a good government standpoint, wouldn't it make more sense to take those interest payments and instead invest them elsewhere, and maybe invest them into hazard mitigation programs? And I think that's a natural segue to kind of my bumper sticker, which is we need to pair risk transfer with risk reduction. So in this case, risk transfer is the National Flood Insurance Program, but it's also private flood insurance. Private flood insurance and other types of insurance like homeowners insurance and business insurance, all of those play critical roles when we're talking about building resilience, when we want to talk about strengthening the nation's resilience against disasters. So taking risk transfer, including NFIP, and pairing it with risk reduction, which would be in emergency management parlance, hazard mitigation, is the way to go, right? You need to both reduce the risk and protect individuals and communities against the financial risks they face in the event that you weren't able to avoid that disaster. In the event you weren't able to buy down the risk entirely, which we'll never be able to do so, obviously. In a perfect world, we would just invest in hazard mitigation. We wouldn't have any risks in this country, but that's not realistic. So the reality is we need to buy down as much risk as we can through hazard mitigation and transfer the remaining risk into the public and private insurance markets. So both the NFIP and the private flood markets. Well, how do we do that? Well, at FEMA, I launched the FEMA Resilience Organization, and that organization focused on all the pre-disaster aspects of what FEMA does. So think of that as of course, NFIP, hazard mitigation programs like we just talked about, as well as preparedness programs. Think of those as three legs of a stool, right? Without one, the stool's really going to start to be wobbly. Without two, it's just going to fall apart. So you need all three. You need preparedness, you need insurance, and you need, as we talked about, mitigation. So we're at an interesting kind of time when it comes in FEMA's history. One would say it's certainly an inflection point in FEMA. The administration has made comments about potentially abolishing FEMA, though I would argue in recent weeks those comments have been tempered as a result of the flooding in Texas. I think the flooding in Texas was certainly a wake-up call that one, FEMA needs to exist. There needs to be a federal backstop to support states both operationally and financially following a disaster. It was also should have been a wake-up call for everything we talked about with regard to resilience, right? So obviously the focus is on the disaster survivors and those who were lost in that disasters, as well as the property and infrastructure that has now, been absolutely devastated in that area as a result of the floods. But if we take a step back and we say, what can we learn from this? I think the learnings largely come in those three categories I mentioned, and they're all resilience. It's preparedness. It's making sure that communities that are at risk for floods know they're at risk for floods and they take actions before that disaster occurs so that the impacts can be lessened. So from a preparedness standpoint, making sure there are evacuation plans, and even before that, making sure there's proper alert and warning systems that are in place. And I think that we saw some of that lacking in that most recent flood disaster. Then we talk about, of course, insurance and NFIP. The take-up rate in that area is abysmally low, low single digits, I think were the numbers. So those that were impacted by the floods will not necessarily have the financial means to recover from those floods if they don't have flood insurance or significant savings. But unfortunately, in most cases, going without insurance means you're putting yourself, your family at risk. And that likely we'll see that play out, not just in the weeks ahead, but really the months and years ahead, with a community that will likely struggle to recover from those floods from a financial standpoint. And of course, that third leg of the stool, mitigation. There were likely actions that could have been taken, investments that could have been made in infrastructure and otherwise, that would have lessened the impacts of those floods. And unfortunately, hindsight being 2020, if only these actions had been taken, preparedness, mitigation, insurance, if only those had been taken, the impacts would have been dramatically less. So going forward, we have to look at those lessons from the most recent flood disaster and realize that we as a nation need to do better. We can't allow this to happen again, and actions that can be taken must be taken. But what we've seen so far from the beginning of the administration until now with regard to FEMA is concerning. It's concerning because some of those programs that could have reduced those impacts in Texas and frankly could have reduced impacts of other disasters that have occurred over the last several months, the funding for those programs has been rolled back, and some programs have been entirely eliminated. One of the programs that I stood up in the first Trump administration was BRIC, Building Resilient Infrastructure in Communities. That program was designed to do exactly what we just talked about: invest in communities before a disaster happens, strengthen the infrastructure, strengthen the communities to make sure that, to the extent feasible, the risks can be reduced. By eliminating that program, I think the nation is now accruing risk that it otherwise wouldn't have if that program is still in effect. That program provided grant dollars to states and to local communities to reduce their impacts. What better way to incentivize a community to take the actions necessary to reduce disaster impacts than than federal grant dollars. And it wasn't 100% funding, you know, it was a reasonable cost share. 75% of the costs would be borne by the federal government. The state and local governments would have to put in their share, 25%. I think that's a reasonable ask and a reasonable investment. In other words, it has both the benefit to the community as well as the American taxpayer. You know, the number we always hear from the National Institute of Building Sciences is every $1 invested in hazard mitigation saves $6 when a disaster occurs. So there's an ROI, and that doesn't even account for what we really care about, which is avoiding the losses that can't be replaced. Human life, right? If we were to take these actions, these risk reduction actions, and lives are saved and dollars are saved, that's a win-win for everyone. So similarly, with some of the rolling back of the HMGP dollars, and to think of HMGP as the Hazard Mitigation Grant Program, that program is the post-disaster mitigation. That is funding that is provided to communities that are hit by disasters to reduce their risk so they don't go through this again. The risks in the case of a disaster struck community, those risks are obvious, right? Because the damage has taken place. So let's not rebuild the same way that was in place before. Let's rebuild more resiliently. And that's what HMGP does. Unfortunately, in recent disaster declarations, HMGP, which is, from my perspective, as someone who oversaw the disaster declaration process for President Bush, I was in the White House, I was the one managing those disaster declarations. I can't fathom not including HMGP for the same reasons we talked about BRIC. The 6-to-1 benefit, the benefit to taxpayers, the benefit to those hit by a disaster, and preventing those future consequences. I would argue HMGP, it protects the federal taxpayer investment. In other words, we are saying as taxpayers and executed by FEMA that we don't want to see those federal dollars that are, you know, spent to help that community recover, to help them rebuild, to see that all for naught the next time a disaster hits and those communities are devastated once again. Why not strengthen that infrastructure, strengthen those communities with that post-disaster mitigation money? So as you can tell, I have strong opinions about resilience, including the BRIC program and HMGP, because I think they are wonderful tools in the toolbox that FEMA should have available to help these communities reduce their risk and at the same time protecting the federal taxpayer investment. So where do we go from here with NFIP? Well, NFIP is badly in need of reform for all the reasons that Lori mentioned. There were a dozen or so reforms that have been proposed. They were certainly proposed in the Trump administration, and they were again proposed in the previous administration for Congress to take action. Let me emphasize this. Congress needs to take action. These are significant reforms that are needed for NFIP that require Congress to act. And until Congress acts on that, on either the previous reforms that were proposed or new reforms that this administration may propose, we're not going to have an NFIP that functions in a way that all of us would expect. All of us, again, the ones that are paying for the program and its shortfalls, which are the American taxpayer, or those that are paying the premiums for their NFIP policies. We all expect NFIP to do better, but I'm telling you, FEMA's hands are tied. FEMA requires congressional action for any of these reforms to take place. One of the simplest thing to take that we can ask for would be for a long-term reauthorization of the program. Having been reauthorized dozens of times over the years, that's not helpful to anyone. Reauthorized with short-term extensions, that's not helpful to anyone. So we need a long-term extension, which should be a no-brainer. I don't even know why that's controversial. And then followed by other more meaningful reforms, following that long-term reauthorization, and empower FEMA to do this. We also need, it's not just NFIP, we also need a robust private market. And so really what we're talking about here is to close the flood protection gap. You need a strong NFIP and a vibrant private market for flood. That, combined with hazard mitigation investments and preparedness programs, that is how we become a more resilient nation. So I'm going to end there, and I look forward to your questions.
Thank you, Dan. Appreciate your insight there. We're going to transition to our final presenter who will take us up to the Q&A segment. That's Ms. Rosemary Raska of the Vermont Department of Financial Regulation, who will provide some regulatory perspective on flood insurance. Rosemary, pleased to have you with us and look forward to your comments.
Yes. Hello, good afternoon. Can you hear me all right?
Yes, we can.
Oh, great. Okay. My computer did not like the WebEx settings, so I'm on my phone, unfortunately, so apologies. I just want to thank the NASC SIPR and the Griffith Foundation for asking us to join you today. And I'm happy to talk, well, unfortunately, about the two flood events that we've had recently in Vermont, but I'm happy to share sort of our response to those. We, as I think you saw our horrible pictures, especially from 2023 in the summer, we had some terrible flooding events throughout the state in 23, and then again, almost on the anniversary in 24. And I will say our department, the Department of Financial Regulation, was very much involved in the state's response to the flooding events. We were participating with probably very frequent meetings with several agencies within the state, the Public Safety's Emergency Management, Office of Disaster Recovery. I won't read them all, but as you can imagine, about a dozen agencies would meet biweekly to sort of help respond. And our department also sent members to the disaster recovery centers, definitely for, I think we had a 3-week period where we were staffing those centers in 24. The other thing, as I said, we had sort of many-pronged approach here, but the state had set up a 211 number where we were trying to gather information about, Vermonters who were needed to report flood damage and seek assistance. And again, our department stepped up and participated in helping to handle that call center when there were shortages. But I think some of that even helped us, before the disaster had been declared. That was, sort of helped inform that decision because we were able to collect information and also assist consumers. The other, I would say, is the other thing we did. We had frequent, I think, sort of pre-disaster. We are involved in FEMA trainings for our zone. I think it's Zone 1, so that we have liaisons that we can contact at FEMA. And so some of those communications were important because it could help us kind of track when, NFIP claims were coming through, and just keep a sense of what's going on in the state. Let's see, what else do we do? We have a really great consumer services team at the department, and they were available to sort of assist homeowners understand, their coverage or lack of coverage. And I think as the other speakers will know, in order to get FEMA assistance, you often have to show that you've been denied coverage or have limited coverage under your homeowner. So that is another service we provided, was just to, assist consumers in getting those denials if they needed them, or navigating the system. Let's see. The other, I would say, we worked a lot on providing guidance on our website around where people could seek assistance or get help. Often those were to the FEMA website, but also other state agencies. And as we often do, unfortunately, we had to post a lot of consumer alerts warning folks about insurance and investment scams and frauds. And that's sort of a function we do all the time, which is to kind of put out there what you need to be concerned about. And let's see. The other, I guess one of the most important things we did issue pretty soon after the flooding events, we issued 2 bulletins one, authorizing the use of catastrophe adjusters and appraisers. And that was just simply so that we could, companies could get help to people faster. And then the other was, in each year we issued these bulletins. The other was simply to kind of remind insurance companies of what's required by law, that they needed to, settle these claims quickly, investigate as soon as they could. They had an obligation to do that. And that, was the second bulletin actually was a little more involved as well, in that we basically instructed companies that they shouldn't be re-rating, underwriting, doing a lot of practices that might negatively impact consumers, simply based on the fact that they were a victim of flooding. So that, and then one other that was really important is that we asked them to provide grace periods for premiums, because a lot of people were, of course, dislocated, so they were not able to get their mail. So there was a lot of, things were complicated, right, for victims of the flooding. And then the third bulletin that we issued was a flood and rain event bullet claim data call, and that enabled us to gauge sort of where damages had occurred, what was the extent of the damage, and by line of insurance, as well as understanding sort of how quickly claims were closing. So, for that, I'm not sure how many of our listeners are regulators, but we sort of lean on each other. I had looked at some other states to get ideas about how to, what information would be good to gather. And then the NAIC actually assisted with the data call itself, which was really helpful. It's a great function they provide. So, and let's see what else we did. I don't want to go into all the numbers on this, but but we were able, a lot of our function too is, as I said, like work with other agencies and be able to provide them with information about the extent of damage and where was the damage, and where, we looked at this by company level, so we were able to see, which companies were affected. Another activity that we've been participating in with the NAIC is the PCMI, the Property Casualty Market Intelligence Data Call, which has also sort of had that focus on the availability and affordability of homeowners insurance, and how, maybe deductibles have increased or affordability issues. It provides a lot of details, and actually we have done things like incorporated the FEMA hazard scores by territory, by state, and, countrywide. So that's another sort of tool we have to look at to see the extent of how consumers have been impacted over time. I guess that's more of an overall climate and affordability area. But the other, I want to say our department, we have spent a lot of time just, attending webinars and meetings on parametric insurance, looking at, how do we help consumers? And I'd say, I know the other speakers have touched on this, but, one concern we're fully aware of is that this affordability issue for flood insurance. And it is hard to ask people to buy flood insurance when they can't afford it. And, how do you measure that? We are also looking at, we've spoken to Maine about their resiliency program. They have a new grant program that they, I think it's in law now, but, those are other areas that, of course, we're interested in, is how do you make homes more resilient so that folks don't have these, disastrous results. Let's see what we're doing here, but yeah, I think that is, not sure, I've pretty much covers it. I did want to mention, like we do a lot of outreach at our department, and have done, I think that is definitely a large concern, is that folks don't understand flood insurance and what's covered and what is not covered on your homeowner's policy. So that is an area of focus for us, is that we, for example, we participate in a Capital for a Day program where we go out to different cities through, or well, they're really towns, throughout Vermont, and just share sort of, you know, what we know about, well, a variety of areas, but especially for us, insurance, and, you know, provide whatever support we can. But I think we are looking at how can we help people better understand what options are out there and what they can do. But again, thank you for having me, and I hope I've addressed your questions. I'm happy to answer any questions as well.
Rosemary, thank you very much. We appreciate your insights through that regulatory lens. Want to welcome back our other panelists now and invite all to participate in some Q&A in the time that remains. And I think perhaps to build upon, Rosemary, a couple of things that you just shared. You talked a little bit about helping to raise the level of understanding amongst consumers. Panelists, want to open this up for all of you. Would you share your perspectives perhaps on opportunities for various players within the insurance ecosystem, the regulatory community, perhaps industry, the academy, to perhaps come together to help raise the level of consumer awareness and understanding around the importance of flood insurance and the importance of resilience and mitigation as well? Not sure who wants to kick things off there.
I'm happy to start. I would say all of us in the industry and across, like you said, the whole ecosystem of insurance have a role to play. Of course, I occupy one small part of that. In case you don't know, Marsh McLennan, leading commercial property and casualty insurance broker. I myself am not a licensed broker, but at our firm, we talk about being the trusted risk advisor to our clients. And I think that applies perfectly in this circumstance, which is if you're an agent or a broker and you're servicing your client, it's an individual or a business, government, it's on us as that trusted risk advisor to educate our clients on flood insurance. And oh, by the way, hazard mitigation, right? So on flood insurance, exactly as what was just said, many don't understand or realize that flood insurance isn't included in your homeowner's policy or your renter's policy or your business policy, right? And so the trusted risk advisors, and again, I'm speaking about agents and brokers, but there's others, but agents and brokers, it's on us, it's on our segment of the industry to educate our clients. And then to take it a step further and say, oh, by the way, here are the steps you can take to reduce your flood risk, which benefits you as the policyholder, hopefully through reduced premiums, and it benefits the carriers and the taxpayers because there's fewer losses, insured or uninsured. So I think, yeah, we all have a role to play, and there's a glimpse into the agent and broker perspective.
Thank you, Dan. Dr. Metters, Rosemary, any color you wish to add there?
I'm happy with the academic perspective, which largely agrees with what Dan's saying. I do think, every state in the country experiences flood loss. There's no state that is immune to it. And so every state has an interest for the health of their economy and for the safety of their community. Every state has an interest in finding a solution to this problem. And I do think that with the advent of better models and better information about what mitigation efforts could be made to protect against flood, but also against flood loss where flood is still going to occur, I think makes it much more viable for the private insurance market to take a piece of the problem, if you will, than was really practicable for them in the past. And so I do think that there's a real opportunity here for the private and public market to collaborate to find solutions going forward. So I'll leave it at that for now, but I do think there's real opportunity here for collaboration to solve a really big problem that's affecting the whole country.
Thanks, Lori. Rosemary, care to add anything there?
Yeah, I'm not sure what I can add. I mean, I think I'll say just having been at the department, a few years now, and I feel like a lot of my focus has been on like climate and catastrophe models. I do a lot of rate filing reviews and just looking at, filling in those gaps. How do we help consumers understand, and then how can we as a department be open to what are these solutions? How can we bring these to market, help to bring these things to consumers? And I think that I know at our department we're very open to contacts from the private industry and having conversations and exploring options. And I feel like that, it sounds small, just like, having an awareness and understanding that you want to move toward, being helpful in any way we can to help folks find solutions. And I really enjoyed hearing these other perspectives as well, because it is a big problem, and a lot of us are in it. But it is, just from our small, as I mentioned, like we do education, like we've had a couple of staff go out to, we call it Bethel University. We do some online, an online program about homeowners insurance and flood insurance, and just the basics of helping folks to understand that. So I think our goal, we do want to have sort of a lot of educational materials on our website just to help folks. And as I said, like go out physically and speak to people and talk to them. But it's also, as far as like things that we approve, products, whatnot, we've tried to be open to the private industry when they've come to speak to us about things they want to bring to market, like parametric insurance, or, that would just be a small part of this puzzle. But yeah, just being, I guess, awareness is important. So thank you.
Thank you, Rosemary. Dr. Metters, want to harken back to some of the content that you covered during the opening of our time together, which relates to a question we received from an attendee asking whether there was a private market for flood prior to 1956. And could you speak to that, and perhaps some of the relative challenges and or issues to the extent you have insight there?
Sure. Yeah. So I'm going to put out the disclaimer that I'm not a historian. I'm not even a historian of risk management and insurance, but I do, I certainly have read a lot, and this is an area I take extreme interest in. So if my memory serves, there was a market, a private market, maybe starting in the late 1800s for flood insurance that was never really robust. It certainly was not widespread across the country. We didn't even have what we would today call national insurers. And so it wasn't this one big widespread market where it was easy to communicate risk or to even model the risk, or to share the risk. But I think if I recall, the Great Flood, Mississippi flood, if you will, of 1927 was a pretty big watershed event for that private market. And so again, forgive me if I'm incorrect here, or if I'm leaving out really important details. And if one of the other speakers has them, please add in. But I believe between 1927 and 1956, there was a real struggle. There was a pulling back on the private market's part to offer it. And that began to have real implications for development of entire areas of the country. So there were states in which regions of the state could not be developed further in a feasible way without a market. And so that was part of that lack of availability in a private market, was the push for the NFIP.
Thank you, Lori. Dan, Rosemary, anything to add there?
Other than I agree, and let's hope that history doesn't repeat itself, and we need to get right. We need to realize some of these lessons. Again, going back to individual disasters or the program itself. Let's learn these lessons as we go forward.
Indeed. I want to switch gears a bit, talk a little bit about incentives and or requirements that the federal government may have, or perhaps they don't, for homeowners in high-risk areas to take action to reduce the costs of large claims, a topic one of our attendees raised in our Q&A. Who'd like to take that?
Well, I always like talking about sticks and carrots, so let me take a swing here. So, of course, I prefer carrots over sticks. Carrots would be some of the grant programs we talked about, as well as other grants that I didn't mention yet, like FMA, so Flood Mitigation Assistance. It's a grant program under the National Flood Insurance Program. And I should have said, I mean, NFIP the program as envisioned does a great job of pairing risk transfer with risk reduction in the sense that is both an insurance program and a mitigation program. And I think we often forget that. And so a strong incentive for a policyholder to elevate their home or take actions that would otherwise reduce their flood risk is if FMA money is available to help that homeowner and help that community take those either, again, structure level or community-wide flood mitigation measures. So strong incentive program. And I'd say federal grants are probably the strongest incentive, but they're not the only. States can certainly incentivize this, and local governments can incentivize this. The private sector can incentivize this. And I would argue the insurance industry does this all day, every day, right? Whether it's the private flood market or the homeowners market or even NFIP under Risk Rating 2.0, there is a strong incentive for you to reduce your risks because it should reduce your premiums. Because an insurer, all they're doing, and the regulators certainly know this better than me, which is that premium should reflect the risk that the insured faces. Full stop.
Thank you, Dan. Rosemary, Laurie, anything to add there?
I'm not sure. I mean, I totally agree. It's funny. It's insurance. It's supposed to, it's got to predict future costs and, and accurately assign the cost to the risk. And I will say one thing, just that I know, just because we've been doing a lot of just fooling around on the FEMA website and in touch with FEMA, trying to figure out, understand sort of the cost of insurance. And I have been happy that there are tools available on through FEMA for figuring out, like, oh, what would these estimates be, and getting a better handle on it, just to understand, I guess, the extent of the problem and the costs. And but so anyways, I don't think I have anything to add beyond our experts here. Thank you.
Thank you, Rosemary. Laurie, anything?
I agree with Dan's comments on that. So
Excellent. We are nearly out of time. I'm going to work in one more question here. We have an attendee who asks whether any of you care to comment on the increase in losses due to pluvial flooding across the country and challenges that may be causing for homeowners. For those unfamiliar, pluvial flooding essentially refers to a scenario where we see increased rainfall creating flooding independent of any bodies of water that might sort of be in play. Any comments in the limited time we have here remaining on that?
yeah, just really quickly, I'll comment on that. Pluvial flooding has been a real challenge and will continue to be a challenge because we've a fast-growing population, a fast-growing built environment in many areas, and that will change the flow of water. The flow of water naturally changes over time as well. And so gutter systems, sewer systems, that urban-suburban interface and the suburban-rural interface, they're all constantly changing. So there's a real dynamic risk here. And that, I mean, the question, the person who asked the question is correct. I mean, it has caused an increase in losses. I think that's going to continue to cause an increase in losses. We can mitigate. We should be working really hard toward mitigating against those risks, but that is a really dynamic situation that does create complexity, no doubt about it.
Thank you, Laurie. Dan, Rosemary, any final comments there? We are up against the top of the hour, but want to give you both an opportunity if you have anything to add.
Yeah.
I think you might be muted, Dan.
I agree completely, and it's not a challenge that's going away anytime soon. The built environment is becoming probably more challenging, not less, over time.
Yeah. Yeah. I I just want to add, I totally agree, and I feel like it is a tough thing to, when things are unpredictable. And here in Vermont, of course, we did see flooding where you just would never expect to see flooding. So, yeah, it's, it is a problem, and I think, anyway, I just agree with those comments, and unfortunately, we have the real results here that we saw.
Thank you. It's been an enlightening discussion. Our time has elapsed. So on behalf of both the NAIC's Center for Insurance Policy and Research and the Institute's Griffith Foundation, I want to thank our panelists, Professor Lori Metters of Appalachian State, Dr. Dan Kanuski of Marsh McClellan, and Ms. Rosemary Raska of the Vermont Department of Financial Regulation. We greatly appreciate you joining us and sharing your insight and expertise. Before we part, I want to invite our attendees to please take a moment to provide feedback. You may do that by completing a very brief anonymous survey. Simply click on the link that appears in the chat box to access the survey. The input you share is quite important to both the CIPR and the Griffith Foundation. As my colleague Erin Campbell noted at the opening, the program will be available for on-demand playback in the days ahead. A link to it will be posted to our respective websites, so we invite you to share that with any colleagues who might benefit. With that, on behalf of Erin Campbell, the team at the NAIC CIPR, and all of us here at the Institute's Griffith Foundation, this is Frank Tomasello. Thank you for joining us. I bid you a pleasant good afternoon.